today's discussion, our topic is other taxable income. Again, I am Rebecca Armakiling, your discussant for today. So what are the other taxable income? This refers to income earned that cannot be classified as compensation. They cannot be also classified as business income or earnings from dealings in properties or passive income. So what are those taxable incomes? So we have interest income, the rents, royalties, dividend income, annuities. You have also prizes and winnings, pensions, and partners' distributable share from the net income of the general professional partnership. So interest income, other than the passive interest income subject to final tax, are included as part of the gross income subject to basic tax. Recall our previous discussion. Interest income from the bank are subject for final tax. So, excluding those passive interest income, you will put that in the other taxable income. Next, we have rent. Rents are income arises from leasing out properties to lessee. A passive income, but is not subject to final tax. Since they are not subject to final tax, they are subject to the basic tax. Royalties are passive income subject to final tax if earned from sources within the Philippines. But how about the royalties earned from sources outside the Philippines? These are subject to regular income tax. Dividend income, these are income earned from the distribution of earnings or profits. We have also annuities. This refers to the amount paid for life insurance in installment basis, and any interest thereof is taxable and shall be also included in the gross taxable income, while the return of premium amount are not taxable. Prizes and winnings of corporations are subject to regular income tax. Pensions are taxable subject to regular tax if it falls to meet the exclusion criteria. The last, the partner's distributable share. Okay, so we will discuss it by one. So let's start with the interest income. So interest income can be part of the other taxable income if the interest income coming from the lending activities to individual and corporations by banks, finance companies, and other lenders. And also if the interest income from bonds and promissory notes and interest income from bank deposit abroad. So our exemption for this is the interest income earned by the landowners in disposing their lands to their tenants in pursuant to the Comprehensive Agrarian Reform Law and the imputed interest income. So you will not include that on the other taxable income. So our illustration is here. Jella Bank has the following income in 2018. Okay, she has interest income from loans for 4 million, interest income from deposits with other banks 300,000, interest income from note with discounting 200,000, and interest income from the treasury note. The question is how much is the interest income subject to regular income tax? So you will include the interest income from loan 4 million. How about the interest income from deposit with other banks? This is subject for final tax. And then you will also include interest income from note with discounting 200,000, while the interest income from your treasury notes is also excluded because this is subject also for final tax. So our total interest income subject to regular income tax is 4,200,000. Okay, rents. So rental payments shall be taxable in the year received, whether earned or unearned, provided there is no restriction as to its use and regardless of method of accounting employed. So, how would you compute the total rental income? Rental payments plus the obligations of the lessor assumed by the lessee. We have also income from leasehold improvements. Okay? So, advance payments or security deposit shall also be taxable upon forfeiture in favor of the lessor or upon application as rental payments. Okay. And then, obligations of lessor assumed by the lessee. When we say lessor, lessor is siya yung nagparenta, no? This is the party. Lessor is yung nagparenta, no? Who rents something out. No? While the lessee, this is yung nagrent. This is the party who rents the property from the lessor. Okay? So, the obligations of the lessor, supposedly, that's the obligation of the lessor, the interest, the taxes, the loans, the insurance premium, but this is assumed by the lessee, no? Gi-assume sa nagrenta, kaya ma-part siya as rental income on the part of the lessor. So, and then we have also leasehold improvements. This is the improvement made by the lessee shall be treated as income of the lessor if the improvements will be owned by the lessor at the end of the lease. The lessor is not required to pay the lessee the value of such improvement. So that is also part of the rental income on the part of the lessor or yung nagparent. So the total rental income would be rental payment plus the obligation of the lessor assumed by the lessee and the income from leasehold improvement. For the leasehold improvement, there are two methods on how to compute the income. So we have the outright method and the spread out method. When we are using outright method, you will recognize the income based on the fair market value of the improvements. While for spread out, the valuation of income would be the book value at the end of the lease term and also the remaining term of the lease. So you need to proportionate it, no, using the spread out. Okay, so we have an illustration. So in January 1, 2019, Belia leased a vacant lot to Oliva. So Bella is the lessor and Oliva is the lessee. Meaning Bella yung nagparent, no? Si Oliva yung nagrent under a 20-year lease contract. Oliva immediately constructed a building on the lot at a total cost of 6 million. The building has a useful life of 30 years. How much of the leasehold improvements should be recognized as part of the gross income on the part of the lessor under outright and spread out method? So under outright method, your gross income would be the fair market value of the improvement. But under the spread out method, you need to proportionate, no? So first, categorize, no? Ilang years may use yun ni Oliva, ilang years may use ni Bella. So take note, si Oliva, yung lease contract natin is 20 years. So meaning Oliva can use it within 20 years. While for Bella, after 20 years, kasi useful life of the building is 30 years. So after 20 years, kang Bella na yun, no? Depending on the contract kung kuan, pero usually kang Bella na yun, no? On the part of the lessor na yun. So you need to allocate the cost 6 million. So proportionately, so 20 over 30 times 6 million. So for the part of the Oliva, that's 4 million. For Bella is 2 million. So we are looking for the gross income, no, of the lessor Bella. So 2 million divided by 20-year contract. So Bella must recognize 100,000 income per year. Okay. We have also dividend income. These are the income earned from the distribution of earnings or profits. So the guidelines on dividends, we have dividend received, it must be dividend received from domestic corporation. So if recipient is a domestic and resident foreign corporation, the dividend is tax exempt. But if recipient is a non-foreign corporation, this is subject to final tax rate of 30%. If resident citizen, non-resident citizen, or resident alien, this is subject to 10% final tax. If non-resident alien engage in business in the Philippines, this is subject to 20% final tax. But for non-resident alien not engaged in trade or business, subject for 25% final tax. Okay? Cash and property dividends. Cash and property dividends shall be taxable upon declaration. For stock dividend, distribution of stock, this is not taxable because they are not realizable income. So except if the stock dividend represents earning, no distribution like option to receive cash property and option, an option is exercised, that's the time you will recognize it as part of your income. For liquidating dividends, these are tax exempt because it merely represents shareholders' returns of capital. However, anything in excess of the cost shall be considered income and therefore taxable subject to capital gain tax. If the amount received by the stockholder in liquidation is less than the cost of investment, the loss in the transaction is deductible to extent allowed for capital loss. How about annuities? Annuities refer to the amount paid for life insurance in installment basis. So any interest thereof is taxable and shall be included in the gross taxable income while return of premium amount are not taxable. So we have an illustration. Jadine purchased an annuity contract for 200,000 which shall pay him 20,000 annually until he dies. So how much of the receipt will be part as gross income subject to regular tax? So the receipt of the first 10 annual in annuity payments is a return of premium. So 10 times 20, so that is 200,000. No? Return of premium, so this is not subject for regular tax. But any further receipt of that, so after 10 years, kung meron pa rin siyang ma-receive, that's the time that is subject for regular tax. How about partners' distributable share from the net income of the general professional partnership? Usually, the general professional partnership are income tax exempt. So, the partner share on the net income are the ones subject to regular tax in general professional partnership. So, the computation of the partner's share in the net income from the partnership shall not include the income from items subject to capital gain tax and the final tax. Okay, so example here. So, A1 and A2, they are the partners. They are practicing their profession in a general professional partnership and share the profit 70:30. So, meaning 70% for A1, 30% for A2. So, they have reported the following. So, meron silang gross receipts of 3 million. Meron silang expenses 1.8. So, net income from operation is 1,200,000. And they have also interest from the bank, which is netted of final tax. Okay? And then, the distributive net income here is 1,220,000. So, you distribute for A1 and A2, ratio and proportion. So, total distributable net income as accounted for A1, 854,000 and for A2 is 366,000. So the amount of partners' distributive share net income which will be included in the gross income of the partners' income tax exclude items that are subject to final tax and the capital gain tax. So exclude the 20,000 interest from the banks because they are subject for final tax, di ba? Okay? So only the 1,200,000 would be subject for income tax. But the 20,000 which is from the bank deposit, you exclude it, no? So the total distributable share subject to regular tax is 1,200,000. Pero si A1 na ang magbayad niyan at saka si A2 na din ang magbayad niyan, no? Okay. Next, gross income from whatever sources derived. The law imposed a tax on income from whatever sources, whether coming from legal or illegal. So examples there is income from wetting, income from swindling activities, recovery of bad debts, refund of taxes, unutilized excess campaign funds, forgiveness of debts. So they are also part, no, of the taxable income. Okay, other sources of gross income which is subject to regular income tax. Income distribution from taxable estate or trust. These are subject to regular income tax provided that such income must not have been subjected to final tax or capital gain tax. And also share from net income, the same treatment, no, with the recognition of share in the net income of a general professional partnership. So share of the net income on the exempt joint venture and the exempt co-ownership. We have also income from farming. So we have For raise and sell operation, proceeds on sale of livestock or farm products is included in the gross income subject to regular income tax. Animal raising expenses are presented as items of deduction against your gross income. While for purchase and sell operations, the gross profit from the sale is also included in the gross income. We have also recovery of past deduction, and then reimbursement of expenses, which is expenses incurred by the taxpayer that reimbursed by the client. It's an additional income on the part of the taxpayer, and also cancellation of indebtedness for a consideration. Okay. Now let's go to the recovery of past deductions. Recovery of bad debts. This is a part of the gross income, but there are some conditions, no? So in order for recovery of bad debts to be considered as income, the following must be complied. The bad debts were written off in the previous years, and such bad debts were deducted in arriving at the taxable income, and there is resulting tax benefit on the deductions. Okay, so let's have our computation. Okay, so we have this illustration. Assume that Alice had the following bad debts expense or account write-off, and there are subsequent recovery of accounts written off. So here in 2018, there is bad debts write-off of 80,000, but in 2019, there are recovery of 65,000. So again, let us go to the basic rules. So dapat naka-write off yung bad debts, then there is a recovery on the next, and then titingnan yung benefit, tax benefit. Okay, the requirement here is how much of the 65,000 recovery in 2019 has tax benefit and must be reverted back to gross income. Okay, so let's first look on the tax benefit of the write-off. So in 2018, there is net income before bad debts, which is 200,000 less the bad debts expense if it is known. So if it is known, we will have a bad debts expense of 15, no? 80,000 minus 65,000 the recovered. So 15,000 lang yung bad debts natin. So net income if recovery is known is 185,000. And then you will deduct it, no? So net income nga na-declare natin on 2018. Okay, so our tax benefit of the write-off is 65,000. So let us compute now the net income or the taxable income. So we have the net income before recovery, 200,000 plus the tax benefit of the write-off, which is 65,000. So our net income that is taxable would be 265,000. Another illustration, supposing Alice has the following data. So our bad debts expense there is 220,000, but it was recovered in 2019 to 220,000 sa 2018, pagka 2019 na recover 200,000. The question here is how much of the 200,000 recovery in 2019 has the tax benefit. So first, let us compute the tax benefit of the write-off. So net income before bad debts is 200,000 less the bad debts expense if it is known. So we have 220 minus 200 na recovered. So we have 20,000 as bad debts. So our net income if subsequent recovery is known is 80,000. So let's compare it to the net income in 2018, but we have a net loss of 20,000. So meaning to say there is this tax benefit of 80,000. So this 80,000 nga tax benefit will be added, no, to the gross income in 2019. So our taxable income in 2019 would be 200,000 plus the 80,000, the tax benefit of the write-off. So that is 280,000. Next, illustration number 3. Supposing Alice had the following data. So we have the net income before bad debts. We have 140,000 in 2018. The bad debts expense is 190,000, but recovered in 2019, 40,000. In 2018, we have a loss of 50,000. So the question is how much of the 40,000 recovered in 2019 has tax benefit. So let us first compute the tax benefit, no, of those recovered. So net income before bad debts in 2018 is 140,000 less the bad debts if known. 190 minus 40, that is 150,000. Again, there's still a net loss. So meaning to say walang tax benefit. So meaning None of the recovery shall be included in the gross income of the 2019. So our net income that is taxable in 2019 would be only 200,000 kasi we will not add the benefits. Okay. Okay, forgiveness of debt. So there are types of forgiveness of debts and the treatment of this one. So first is debtor performs service to the creditor. So the tax treatment here is it is a compensation income. Next, when the creditor desires to benefit the debtor without any consideration, this is considered as gift or donor's tax. If the creditor is a corporation and the debtor is a stockholder of such corporation, the tax treatment is dividend income. So, ayun, no? In reporting of gross income. So, we have the accounting method. We have different accounting method, calendar year and fiscal year. Okay. So, instances when use of calendar year is required, taxable income shall be computed on the basis of calendar year in the following cases. If the taxpayer's annual accounting period is other than a fiscal year. If the taxpayer has no accounting period, if the taxpayer does not keep book of accounts, and if the taxpayer is an individual, usually we are using calendar year rather than fiscal year. Most of the corporations, if they are incorporated not on January or not on January something, so they are using fiscal year pro. But there are also corporations who like to use fiscal year. Okay? But most of the individual taxpayers, usually they are using calendar year. Next, short period return. Accounting period may be less than 12 months. May arise when a corporation is newly organized, when a corporation is dissolved, when the taxpayer dies, and when a corporation changes the accounting period. So it depends upon the corporation whether they will use calendar year or fiscal year. Okay, and for short-term period only if it is newly organized and dissolved, etc. So those are the situation when why the taxpayers use the short-term period.